Sanjay Mookim joins us. It's been a while we've not interacted with him. So nice to have him back on ET. Now, Sanjay, good morning. Good to have you back. I was looking at your report, and your report has a very interesting take in terms of how you've divided the market. Momentum, earnings, and valuations. So let's start with the first one, momentum. Because I get a sense that more than anything else, there is momentum in the market. How would you start with the current market setup if you have to describe it under the headline momentum?
Well, morning, good to be on. Look, I think India has benefited from a confluence of a whole bunch of positives in the last couple of months. Relative valuations for the market had gotten comfortable. I mean, they were not cheap, especially on a bottom-up stock level, but the premiums that we were trading at to the S&P or to EM, those premiums have come down significantly. At the same time, the macro condition for the economy was improving. The external account situation has improved dramatically, with the current account deficits diminishing almost completely, with growth surprising on the upside and inflation going down. And the last bit that helped us, to my mind, was this view from global investors of increasing concern on Chinese equities. With the China market flattening out and even actually falling, there was a shift in investor attention from North Asia to India. So this confluence, low valuation, improving macro, better relative position, has created that momentum in the market that you're talking about. Now, to my mind, all of the underperformance that we had earned in the middle of March or so, a lot of that has been covered, and any further momentum from here will depend entirely on what the global equity market does. So if the S&P continues to rally, we may also have further legs. But on the other flip side, if we do start to see correction, as most people expect, in global equities, then the India momentum will also probably fade away.
Great. Now, earning revisions. Earning revisions have happened. They've happened in case of consumer durables, autos, and IT. Sum total, where do you think FY24 is headed?
It's a very interesting question. Now, there are two parts to that story. If you look at the fourth quarter number, so most companies, or let's say majority of companies in the large cap or mid cap indices, have beat the bottom up expectations for the quarter recently. And this is not just because of higher margins. If you break down the beat, it has been also because of better top line delivery than people had expected. So that's why you get this tone, oh, things are getting better and companies are beating estimates and so on. But the challenge is that for FY24 and 25, the expectations were already so high that despite the beats that we've got in the quarter, most companies have seen flat to down EPS for FY24 and 25. You've seen earnings cuts despite strong 4Q numbers that have been delivered by companies. Consensus today for the Nifty pencils in about 18% growth for FY24. We did a scenario, paring down the growth expectations, taking a more reasonable sort of outlook. And my expectation is that we'll probably end up more like 11-12% and not 18%.
Right. Sanjay, what's actually stood out for me is the India model portfolio changes that you're making. And, I'm going to come to the ad weights a little later, but the cuts for Reliance, HDFC Bank, ICICI Bank, that's what's standing out for me.
Well, look, I will not comment on single stock names on TV. We are not allowed to do that. But from a model portfolio perspective, we continue to stay overweight financials, and we've added actually some PSU banks to our portfolio. And we also like on the margin non-banks, given the growth momentum that has been delivered recently. We like two-wheelers, staples, and we continue to be underweight IT. We keep making these portfolio changes on stocks here and then, but on core, we continue to remain overweight the financials.
Looking at an earlier note of yours, and you were talking about how El Nino could be a modest dampener in 2023. What do you think the probability of that is going to be, and what impact do you expect for particular specific sectors?
If you look at a 75-year history, and we have the data, then every time you get an El Nino, you do get lower than average rainfall in India. Now, I know the Met is talking about the Indian dipole condition as a compensatory factor. I'm not smart enough to understand that very well. but the historical evidence suggests that El Nino does lead to a deficiency in rainfall. And if you analyze that by state, the most of the lower rainfall actually happens in the drier northern sort of areas of the country, and the southern states tend to get away with lower cuts to rainfall averages. Okay. Historically, this has led to lower agricultural GDP, lower rice production, lower wheat production. All those correlations hold up. The only saving grace this time around, two things. One, irrigation proportion has gone up, so the sensitivity to rainfall is lower than it used to be in 1980. And secondly, India is now a surplus country on the basic staples, and therefore we shouldn't have shortfalls. We've done correlation analysis of rainfall with sector sales, and the only sector where rainfall tends to affect sales volumes is two-wheelers. It doesn't tend to matter too much for cement, four-wheelers, tractors, and so on. But for two-wheelers, we've historically seen an impact of lower rainfall on sector sales.
I want to go back to that point again, which is that in this market rally, and we understand that there are a lot of ETF flows which have come into India. ETF means that you are increasing your country allocation. It is not about individual stocks. But in this rally, the three horsemen of the market, if I may use the word, Reliance, HDFC Bank, and to some extent Infosys, they have not participated. It's not a stock specific comment, but the general view that flows have come back and the heavyweights have not participated.
Yes. Look, I have always argued that you can never paint a complete picture of the market just on basis of flows, because we don't really know the complete flow picture at any point in time. In fact, even the retail level activity data that we can track for the fourth quarter tells us that retail has returned to the market, or at least until March, retail was buying, but they were still only buying the large caps. And this data is available from company disclosure. Almost all of the new retail money went into the large cap stocks, not the mid caps and not the off benchmark stuff. Their problem is that the liquidity in these mid caps or the smaller names or the off benchmark names is so low that even if you get a marginal interest in these names, the stock prices can move significantly. So my suggestion is that this mid cap momentum is likely to be temporary, because like I said earlier, you've seen earnings cuts despite the strong quarter, and the entire rally that we've seen in mid caps has been on account of higher valuations. And you can take that phenomenon only to a certain degree. It is a beta sector in the market, and if we believe that the market's kind of topping out, at least in the short term, then mid caps could present to be a problem.
Question which in a sense we are discussing and debating with everyone is that the rally in US equities, especially in some of the US tech stocks, Nvidia, Microsoft, how can one really maximize by betting on this entire AI theme? As an Indian investor, what are the options for us in India that if the AI boom is coming, how can I make hay while the sun shines?
There are very few options in the immediate term, or at least if I rephrase it, there are not too many obvious candidates which will benefit in size from AI. It will happen over time. Indian companies will find ways to participate in this, will innovate and use AI, and deliver use cases, whether it is from a consumer facing point of view or whether it is Indian IT companies becoming part of the implementation of AI eventually. At the moment, it's a bit too early to kind of call out a sector or stock beneficiary, but over time, I'm sure some Indian companies will find a way to participate in this.
Again, going to your portfolio, that is the most meaningful part which everybody wants to understand. Hero MotoCorp makes an addition. Dabur is added back. There is Bandhan Bank which is right up there. NBFCs are making a comeback. Is there a play on rural stroke value which you are betting on for rest of the year? I mean, is that a underlying thread which you're connecting with, let's say, inclusion of a Hero MotoCorp or a Dabur or a Bandhan Bank?
The argument we've made, and we've been making for a couple of months now, is that the consumption outcomes for the bottom 80% of Indian households will improve. There are several data points that are encouraging to my mind. We've seen jobs data, the quarterly PLFS data that we get has closed all the gap that was created during the lockdown. Consumer confidence numbers are going up. Wages have stabilized. In fact, wages are positive in real terms in rural India. And we've seen corporate utilization step back to where they were pre-pandemic as well. So to characterize all of this, the hole that was created in the Indian economy due to the lockdowns in the past has now largely been filled. I mean, there is still a debate of the pace of growth here on, but I'm out of the trouble that I was in the last sort of 2 years. And this means that the stresses I have seen on consumption, especially in an environment where prices are likely to be flat or down, those stresses go away. And therefore, some of the sector changes or allocations we make reflect the hope that we will see better outcomes on the lower income consumption.
Sanjay, I wanted to talk about the financial space because that seems to be the consensus buy. But within financial space itself, there are a lot of pockets, right from your mid-sized banks, your housing finance companies, microfinance, as well as the entire NBFC pocket. Which is the space that looks the most interesting to you?
Well, in terms of size, the large cap private sector banks still look great to us. There is a good growth value combination there and limited risk to earnings. So it's very unlikely that you will see significant earnings misses or downgrades or any of that for the next 6 odd quarters to my mind. And within the economy, if you do a scatter plot of valuation versus growth, the Indian large cap private banks stand out as being the most attractive to my mind. It is boring, I know, everybody talks about it, everybody agrees with me, but boring, it doesn't mean it is wrong. I think they will continue to compound steadily. So that remains our core view. We like insurance from a medium-term valuation, and the penetration argument remains secure. But in the short term, we've actually added some of the NBFCs to our portfolio because the growth momentum is coming back. Now, this could end up being more beta and more cyclical. The growth could slow, or you could see credit cost coming in faster than in the banks. But given the momentum of growth at the moment, we've added some NBFCs to our model portfolio.
Sanjay, there is going to be an election cycle in next 1 year. And in India, the election cycle is always considered to be a binary event, considering the last 3 experience of election cycle, how markets have reacted. Has this entire kya lagta hai narrative started with institutional investors, especially at a global level? And do you see some reluctance coming ahead of the election cycle somewhere?
Not yet. If your question is a feedback on my conversations, the answer is not yet. It's a bit too soon. I expect this to start to happen in a couple of months from now. We've done some work previously and on the behavior of sectors in and around the general election. And empirical data suggests that sectors such as industrials and banks outperform 3 months into the election, and consumer kind of stocks tend to outperform 3 months after the election. It's a bit counterintuitive. People expect the consumption pack to do well before, but that's not been the case historically.
So if someone who's watching the show and say, Sanjay Mookim, I was bearish at the beginning of the year, but I liked your interview in ET now with Anisha, Aisha and Nikunj, and I'm convinced that I want to buy India. Please give me ideas. I'm looking at 10-12% return in next 1 year. How would you address that client? It could be a real question. You may get this question right after this call.
Well, I'd say,
Sanjay.
look, if you
Trust
are
me.
positive on...
You may get this call after this interview.
No,
People
I'm
are
sure
watching
you
us.
do. Look, the way I answer is that it's easier to be positive on equities the longer time horizon you have, right? The more patience you can bring to the table, the greater the assurance of return. If you ask to make 5% returns in 6 months, the confidence I can present to you will be lower. If you ask for 12% compounding over a 3-5 year period, the confidence in that answer is much, much higher. So if you are patient, there is enough opportunity in equity markets. The more you trade, it's an odd thing to say for a broker, but the more you trade, the less the probability of making money, to my mind. India is still a great economy. It will still structurally continue to do well and better than many peers over the next several years. And any sort of long-term investor should consider corrections in Indian valuations as opportunities.
Sanjay, and just wanted to wrap up the conversation by getting your view on real estate as well, because that pocket is also seeing quite a bit of institutional investor interest now. But is it limited to the top strata? Is it across the board? Is there any particular geographical breakup that Street is liking there?
Well, our feedback is that this is a very secular trend. And it is likely to sustain. So there was concern amongst investors, and rightly so, that the increase in mortgage rates would kill the nascent upcycle post-pandemic. We are seeing no signs of that at the moment. In fact, The recent increase in rentals across various parts of India should support capital values as well, and sales transactions remain robust. Additionally, many real estate, at least amongst the listed space, have cleaned up their balance sheets as well. So you have a great combination of good growth over time with decent balance sheets for companies, and we are overweight the real estate sector in our portfolio as well.
Sanjay, on that note, we'll let you go. Appreciate you joining us on the show and talking to us about the multiple facets of the market at this point of time. But talking about the facets of the market at this point of time, we're just 13 points shy of that life high level on the Nifty. We went very close.